What's up, guys? Crypto Savvy here. This is tutorial number 2, and this one's going to be on breakouts, identifying bull flags, bear flags, rising channel, falling channel, and kind of teach you how you would play the breakout. I'm going to look at the lower time frames. We might go into some higher time frames, but you can do this in any time frame, guys. I like if you guys watch my channel, you know I don't agree with day trading. I don't like day trading at all, especially in this bull market. I'm more of a swing trader. I could be in a trade for, you know, anywhere from a couple days to a couple weeks. So that's how I like to trade. It's a lot safer. And I don't trade my coins. I hold all my coins. I hold my Bitcoin. I hold my Litecoin and some other shit coins. And I trade Bitcoin on leverage with a cash trading account. So, and then I use my profits to buy more Bitcoin and Litecoin. So that's my strategy. Doesn't have to be yours. But anyways, we're going to look at these charts. Do keep in mind, check out the description below the video. There's a free link to my Discord group in there. Awesome group of people. Great community. If you love crypto, you'll love the community. You don't have to be trading or whatnot. It's just everybody, you know, there's all different subjects in there. People talking about different things going on in crypto. There's also trade rooms. There's, you know, charting rooms. Just check it out. I'm pretty sure you'll love it. If you like crypto, you'll love the community. Very friendly community. No bashing allowed in there. Also, there is some affiliate links down below that really help the channel out, guys, if you use them. If you can, great. If you can't, that's okay too. There's a couple exchanges in there. There's Prime XBT. There's Bybit Exchange. There's COINBASE, ABRA, Ledger, and there's another one, Crypto Keys, to keep your crypto keys safe. Check that out also. If you can, like I said, if you can use them, that's awesome. It helps channel out. If not, no big deal. I am going to get into the charts, and we're going to look for some patterns. Alright guys, here we go. I pulled up a little cheat sheet here. There's a lot of them on the internet. All you gotta do is Google chart patterns and they'll come up. There's a lot of different names for these. People change names. I don't know why. You know, they got the bull pennant, which I call bull flag, but this they consider the bull flag, which is pretty much the same thing. It's a continuation pattern. We're going to look at a few and kind of find some that break the wrong way so you can be aware of how stop losses and things like that work if you're trading. Let's look at some, you know, potential trades. This is one that could have been tricky right here. This is a bull flag or bull pennant, whatever you choose to call it. Same thing. It's a continuation pattern. But right here, that's what it looked like it was forming. And how you normally would play that is if you were gonna play the breakout of this is where you would have shorted, and then what you would do is put your stop loss just on the other side of that, of the breakout line. And because a lot of times when, say if this did work out like they're supposed to, this would have came down, probably came back up and tested the triangle for resistance and then come back down. But this is kind of a tricky one. Obviously, it broke down, and if you would have shorted it there, it came back up, hit your stop loss. Looked like it was continuing up and then another drop. So be aware that some of them are extremely tricky, but this is technically a bull pennant that broke bad. Let's see if we can find some more in here. Here's a bull flag. I guess you could consider this one a bull flag. Let me get out of here. Right here would be the flag pull. This would be your flag. And this was kind of goofy. This wasn't real clean, I guess you could say. But not all of them are. And you would have done a measured move, measuring the flag pull from down here up to up here. And that would have gave you a target of the 13,000 range, 1330. And obviously we did go up higher, but then drop. So, and how you would play that is the same way. You would have put and this is the 15-minute chart, guys. But you would have put a buy on the breakout here. and when it broke out, would have got you in the trade. You would have put a stop loss down here, and if you were playing just the breakout, you would have used this as your get out point. Another way to safely do this is if you would have put your trade in just above the flag here, if you would have put your buy order in. Some people wait until it passes the flag. You obviously didn't get as much of a move, but a lot of times people say it always comes back down to retest. But as you can see, this one did not come back down to retest. So if you'd have played the breakout, you would have had your buy somewhere in the 12.6 range, and you would have rode that up to our measured move. What happened to it? I took it off there. You would have taken that to the measured move of around 13,000. So if you would have played that, you would have set your stop loss down below the flagpole here, or the top of the flag, and then as it moved up, you could trail it and move your stop loss up behind it. That way, if it did take a dip down, you were already in profit. That's a way a lot of people play. Let's see this. See if we can find a couple more of those. This one could be considered a bull flag or a bull pennant also. That's not what I meant to do. This one's kind of a funky shaped one. Obviously they're not all going to be the same. But as you can see, that one there could have been considered a bull pennant also. And the measured move off of that one would be, and again guys, I don't recommend day trading, but for those of you that have a higher risk tolerance and more time, I don't have time to do day trading, but again, you can use all these on the bigger time frames too. And I'll move into the 4 hour and look at a couple of those too. These are all pretty quick moves, guys. So anyways, that would have put your target at that would have put your target at 12.5. Now what you'd have done here, as you can see if we zoom in, this one almost came back down to test. But if you'd have played the breakout here, which would have been in this area, the 11.9, you would have rode that up to 12.5. Now, like I said, if you were to get in this trade here, you would go long up here. You'd put your stop loss just below this line. And if you really wanted to, depending on what leverage you're using, I don't like high leverage. 5x leverage is all I really use, but you would put your stop loss down here below the break of the triangle on the bottom. But I would probably most likely play it up here, low risk. Anyways, you would play that breakout. Like I said, your entrance would have been around 11.9, and obviously that would have been a $600 move in a very short period of time. This is within a couple hours, well, a few hours once we go over here. But that would be the target. Like I said, once it breaks up and you're into profit, you can always trail it with a stop loss. This one would have made a pretty nice move. Problem with trailing stop loss is once you got up in this area, if you're still trailing, this wick may came down and stopped you out. But the good thing is you would have been in profit. That is a safe way to trade. It takes a lot more time and it's a lot more getting in and out. If you are, hold on a second, I gotta shut this thing off. My phone never shuts up. So if you guys email me or instant message me or whatever, and I don't get back to you a lot of times, I got a lot of stuff going on, tons of people. I do get back to you eventually, but my phone's just blowing up all the time, guys. So anyways, and I do want to help people out as much as I possibly can. So don't think I'm ignoring you, because I'm not. I just get really busy and I have a life. So why is this getting stuck on there? All right. Oh, dang it. There's another pennant right here. If you look at this one, and while it's forming, guys, obviously it's not as easy to find these, but there's a pennant there, and that would be another. You would measure the flagpole from down here up to the tip of the flagpole and put your measured move, and that would have brought you up from you would have put your buy in here or your long around the 11.4 or 11.5 range, just above the pennant here, and your stop loss just below. And as you can see, this one broke out, went straight up to the target and a little above it, but it would have been safe to put your target at 11.950 from 11.4, 11.5, 11.450, 11.5, right in that range. So, you know, you're looking at a $400 or $500 move. So on leverage, if that was 5 times leverage, you know, and playing on one Bitcoin, that's a $2,000 move. So anyways, and the same thing, if you'd have trailed this with a stop loss, you'd have been pretty safe all the way till up in here. You might have got wicked out. But if you put your exit up at that 11.9, this would have been a beautiful trade. But like I said, they don't always work out like that, but you can minimize your risk by using a trailing stop loss. Now let's look for some bearish ones. There's a lot of them here, but let's just pick one out. Here's one here we'll look at. As you can see, dang it, I don't know why my tools don't just stay the same, but right here, this one is more of the straight across, which I think they showed it, yeah, right here would have been the they call it a rectangle continuation. But if you were to look at that and do a measured move off that, now the proper way to do that would be from the last breakout, which is right here, measuring that as a flag pull, this being the tip, this being the start, and the measured move of when it broke down, and that one hit almost exactly. Same thing, you would have put your buy down here. Let's zoom in and kind of look at how this one reacted. You would have had your buy down here and your stop loss here. Now this one, you can see the wick came back in, so that could have stopped you out. And like I said, that's why some people put them, you know, well, on this is a short, obviously, so you would put it above the top of my resistance here. That would be a, you know, $100 somewhere in there. So on 5 times leverage, could be a 500 times or $500 loss if you were playing with 5x leverage. But the gain could be from 11.45 to, I mean 10.45 to a $600 move. So 600 times 5, a $3,000 move. So, you know, you gotta, if you guys are just starting trading, I suggest if you're gonna do leverage trading, start out with really low. You can get on Kraken, start an account, do, you know, single leverage or, you know, 2 times leverage, and just real small amounts to get used to it, because it can be dangerous if you don't know what you're doing, and especially if you haven't learned to handle your emotions well. It can be very dangerous. So here's another, well, there's another pennant here. Let's look for some rising and falling wedges now, if we can find any. Oh, here's one that I was talking about. This is kind of like a false breakout. Could consider it a bear trap. And when they call something a bear trap is because, let's put this, let's go up here. This would be right there. That definitely looks like a bull flag, as you can see. Actually, move this down a little bit. So obviously you can see that looks like a bull pennant or a bull flag. So now looking at this, actually put it more like that. There we go. As you can see, we have the touches. There's 4 touches on the top, and then we have the 3 on the bottom. So 4 on the bottom, actually. But that looks like a more of a falling wedge, which I still consider a bull flag when it's on the top of a flagpole like this is here. And what we would do is measure the move off the bottom of the flagpole and up, and you would play the breakout when it broke above here. Now, if you were going to play this on the bearish side, you would have played a short here, and put your stop loss in here. So you would have got stopped out, because that is a bear trap. That got a bunch of people bearish. So a bunch of people started selling into it, and then it came up, stopped them out, continued up, and made them buy in higher. Now, if you was to play the breakout above this, you would have got in right around 12,550, and your target would have been 13,670. So that would be what? Yeah, over $1,000 move within, hardly any time. That would have been about a 2 hour, or no, I'm sorry, about a 6 hour move. But as you can see, that would have been a safe move if you got in. But if you would have trailed their stop losses here, there would have been chances of getting stopped out as it, came back down and wicked down. So say if it got up here and you put your stop loss just below it, you got wicked out. So that again, that's why I don't like day trading. It's too much action. You got to sit in front of the computer for too long. But if it works for you, great. But that is just a little bit of info on playing those breakouts. Let's go into a little bit higher time frame. Let's go into the 4 hour. Where am I at here? Figure out where we're at. Okay. And let's look for some more patterns here. This here looked like a rising wedge. If we drew a line from each one of these wicks all the way up, see how we have all these touches on there? That definitely makes that line valid. And then we take another one down here. We actually got wicked out a couple times. See, I like to use my wicks. A lot of people are okay with using bodies. I do not like using bodies at all. So this for me would have been more like this. Obviously, this is more of a rising channel, but I guess, if we use the wicks up here, it's questionable. We could consider that a rising wedge, but you can see what happened with the rising wedge, and the measured move off of the rising wedge usually comes down to the bottom of the wedge again. Another way that can be measured is take the widest point of the wedge. So this one isn't the greatest example, but you can still get a good idea from it. And the measured move of the breakout of the rising wedge, which rising wedge are usually bearish once they get to the top, like this happened. This was more like a bear flag. But anyways, that would have, if you would have shorted that, that would have been a safe short, and then you would have collected your profit down here. So you would have went from the breakout of 7,100, you would have went short and closed out at about 6,400. So a $600 move, again on 5 times leverage, would be a $3,000 move. So if you were playing with one Bitcoin. But again, I don't risk my coins. I don't trade my coins. I have a cash account and I use that to trade leverage with Bitcoin. Let's look at another thing here. This was a ascending or descending triangle here. And this was back in our December. And we would put this measured move didn't really, right here would have been more straight, and a better measured move right here. If you did a measured move off that, and this is, like I said, guys, this is just simple breakouts and simple movements. But as you can see, that one almost exact to what this descending triangle played out. They usually break bearish, especially when they're in a bearish trend. It is a continuation pattern. Not all the time. They can break the other way, but 80% of the time or better, when you find a descending triangle in a bearish pattern, it's going to be a continuation of the bearishness. So let's look at what else we got here. These are, if we're looking at patterns, I don't know if this pattern was on there, but if you were watching my channel, we were following this as a Adam and an Eve, and I don't think that's on here. No, it's not. But we'll take a look at that real quick and take a look at the measured move of Adam and Eve. So Adam and Eve, and this did pretty much play out as Adam and Eve. Obviously, we went a lot higher, but if you took a trend line right about there, and you looked at this Adam, this is considered an Adam. It's more of a V shape, and then the Eve is the rounded shape. And the measured move off that, and I know it's going to be a lot to take in, especially if you guys are new to this, but the measured move off of that Adam and Eve pattern would be measuring the longest point here and putting it up to the breakout. And once you broke that line, as you can see, we had the resistance here and here. And you can see how close that got you. And then once you're up in this area, you would have got out of your trade here and then, you know, waited to see what's going to happen. When you get out of a trade, doesn't mean that it's automatically going to go down. When you use these measured moves, they give you time to get out and then see where the market's at and what the market's doing. And you can obviously see what happened there. Then here, if you watch what happened after that, we had what looks to be a rising broadening wedge. And usually these are bearish. Usually a rising broadening wedge will break down and a falling broadening wedge will break up. But since this market is so bullish, even the bearish, if we took and put that up to the breakout, that would have took us right here to this wick here. Then you would have gotten out of the trade there if you played this breakout. But the thing is with the rising broadening wedges, and I think they do show that in here. Do they show those in here? No, it's not in this one. They don't have the broadening wedge, just the regular wedges. But the broadening wedges usually, like I said, if it's a rising broadening wedge, it usually breaks down. But this could also have been considered as a continuation pattern. Yeah, it depends on what wicks you would have used here. But like I said, if you guys follow my channel, I like using the wicks. I don't like discounting the wicks. If you do any research on Elliott wave and triangles, and no, I'm not a huge fan of Elliott wave, but that is what I used to trade with. That's why I started trading with. But they do have some good points, and it says like anytime there's a triangle formation, once it's wicked through for any reason, then it's invalid. Then the formation's invalid. Let's look for some others real quick. Let's look for head and shoulders. I don't know if I'm going to find any in this time frame. Let's go to the hourly chart. See if we can find a head and shoulders just to get some examples of how these play out. I know we had some recently, but head and shoulders is another one that you can play. A lot of people don't like them, say they don't work, but I've done pretty well off of them. Let's see. Could this be one here? No. Excuse me. Diamond reversals, another pattern. I don't know if this quite qualifies. It's pretty close. You want to usually have more touches, but a diamond pattern would be a reversal pattern, and usually in those you will have two big wicks. This one, like I said, isn't the prettiest, but it can be used as an example. Put this up there. This is usually a reversal pattern. So if you find it at the bottom of a trend, it's saying the trend's going up. If you find it at the top of the trend, it's usually going to go down. But a lot of times these will break and it'll fake you out. And what people do is when they play this breakout, they'll have a stop loss above the peak, because sometimes it will do a fake out and it'll stop. If it doesn't break this peak, that's where you would want to play on the bottom. you would want to play it below this peak here. Once it broke there, then you knew it was going to continue. A lot of times they'll break out, it'll be like a fake out and then come down. All that meant was your line could have been wrong, but they call it a fake out. So let's see what else we can gather here. I did want to find a head and shoulders or an inverse head and shoulders. It's kind of hard just looking at the charts like this, but let me go into the 15-minute. I'm sure we can find one in there. But again, you can find them on a time frame, and I guess when you're actually in the market, playing the market, it's a lot easier to find this stuff. Get this down here as it's forming instead of looking for it, you know, as not. So let's see real quick. Here's one here. Kind of. Nah, not the best example. I don't like that. Let's see. Sorry again, guys. I just didn't want to pre-record and have a bunch of stuff circled. I kind of wanted to see this one here. Looks kind of, but just I don't like how it formed there. Yeah, I'm not finding nothing that I. Well, a head and shoulders. I guess I could draw one out real quick. Here's one, kind of. Maybe. No, that one isn't one either. Yeah, I'm not finding any really good examples, guys. Might be easier on the 5-minute. Let's see. Not really seeing anything here either. All right. Well, anyways, here I'll go into a blank and draw. And I'll just show you how the measured move would be if you found one. So a head and, first of all, we'll look at a head and shoulders. That's not what I want. And a head and shoulders would be something like this. That would be the left shoulder. Then you would have the head and then the right shoulder. And this neckline you would want to be almost straight. They can slant a little, but this would be the neckline here. And how you would measure a move off that would be, and this would be coming from this area, guys. So how you would measure the move off of that would be measure the tip of the head. Whoops. Measure the tip of the head down to the neckline. And then you would play the, wow, dang it. Okay, let me do this. Let me change the color of this real quick. I apologize. So how you would play that is you would measure the tip of the head down to the neckline, and then wherever it broke out. So if it was on a slant, you would still play it from the breakout of the neckline. So your target on that would be down here in the 1164 range. So if we go, let's move this stuff here, get this out of the way. And the same would go for an inverse head and shoulders. And the reason I want you guys to understand this, because I talk about it a lot and people always ask. They don't, I guess when you're doing it for a while, you just figure everybody understands the lingo, but that's not always true. And the neckline would be across here. And that would be the exact same thing, just the opposite. And how this usually would have formed is in a downtrend. So what you would do is, off of that one is the same thing. You would measure to where the breakout is. And again, remember that these lines can be slanted a little bit, and they still can play out. A lot of times you'll have a fake out. It can break up and come down. So you always have to definitely play with stop losses, especially if you're new. There is times I play with bigger stop losses because I only play with 5 times leverage. But definitely, if you're just beginning, play with very small amounts, guys, until you get comfortable with it, until you can get to a point where you don't have emotion. You can make a plan and stick to the plan, because if you're playing on emotion, you're going to get wrecked, especially day traders. I don't like day trading because statistics, it's proven that it's 90% of day traders lose everything. And I don't care what people are saying online. If someone says he's a day trader doing great, 10% of them might be, 90% are not, and a huge percentage of the ones on YouTube and the internet are bullshitting if they're saying they're always profitable. It's not like that. They might get a couple great trades, get lucky, but they usually lose it all. That's why I like swing trading. It's safer, less stress. You ain't got to sit and stare at computers all day. But anyways, yeah, that was just, like I said, just want to do a quick tutorial on breakouts and playing breakouts, and that's just a couple you can look for. You can look up the patterns. They're all over the internet. Just Google chart patterns, breakout patterns, and, you know, start practicing with that stuff. And honestly, I said, you know, start with a small amount of money. There's actually, I think it's called eToro. You can set up a fake account and just start doing it fake. You know, you can use fake leverage with fake money and learn it. Now it is a little bit different because you're not actually risking money, but that'll help you get used to it. And then when you want to dabble into it, you know, put a little money in an account, small amount, something you're not gonna, you know, be worried. It's not gonna hurt you if you lose it, and start playing with it. And then start learning about the emotional part. You got to learn to keep emotion out. Emotion will wreck you. It will absolutely wreck you. And remember, especially if you're going to try day trading, there's a 90% chance that you will not succeed. But anyways, that's this tutorial. I am done. I will have another one set up for tomorrow. Appreciate you guys stopping by. I'll be back soon with my daily updates. I am just out of town now, so yeah. If you're new here, you like the channel, definitely click the Crypto Savvy logo above my head. That'll get you subscribed to the channel. Tick the notification bell to get you notified. Smash the likes, guys. Leave your comments. Let me know what you think. Sorry, this might be kind of a fumbly video, but I'm trying to make them quick so you guys have them for when I'm off. I didn't have a whole lot of time to make them, but thanks for watching. I appreciate it, and have a great day.